Welcome to Real Talk Podcast with the HomeField Group. I'm Jeff Bauer, broker at Royal LePage. This is Kathy Dawson. She's a broker with the HomeField Group at Royal LePage. And today we have a special guest from Mainstreet Credit Union, Sandra Coombs. She's going to talk to us today about financing and how we're going to get all those funds that we need to pay for a house, because houses are expensive and most of the time people need to have a mortgage in order to buy one. A mortgage is a big loan. So Sandra, if somebody comes in to your office, they make an appointment with you, what are the first steps and what sort of documents do they need in order to get the ball rolling for pre-approval?
Well, we need, of course, specific documents. So we need to see a snapshot or a statement of where the down payment is coming from. We need to see, like, if they've seen a home already. It depends. Have they seen a home that they want to purchase, that they're interested in, that they want to put an offer in on? Then we need to see which property they're thinking about. Have they put an offer in already? We need the agreement of purchase and sale. Basically, income. You know, it depends if they're self-employed, we would need 2 years notice of assessment.
So when they come in, let's say they haven't looked at any houses yet, and they come in and they want to get a pre-approval, because us as realtors, we like to know that the person's going to be able to afford a house before they start looking, because it could be a waste of their own time, our time, seller's time. So if they're coming in for a pre-approval, you'd need to know their income. So like a pay stub? Just
a couple of recent pay stubs to start with, yes. If we need to go more in depth, if they've switched around employment a lot, we might need to get a little more than that. So we're looking at like a 3-year history.
Okay. And then any student loans or debts that they're paying.
Exactly, yeah. So when somebody's coming in, I don't necessarily like the word pre-approved, because that gives people the impression they can go out and put an offer in on without financing.
Right.
And that's one of the things I've come across a lot in the years that I've been doing this.
Yeah.
I've picked up a bunch of deals where they've thought they had approval in place because of the pre-approved word, and they actually didn't. So the financing dropped. We came in at the last minute, and we're able to, thankfully, help them out. So I prefer to use the word pre-qualified.
Pre-qualified, okay. So
it's a better word to use, because then if they come in to do that, they need income, savings again, because we still need to look at where that down payment is coming from.
That makes sense. And we're pretty diligent too about asking them questions about how far they've got with that process to make sure that financing condition is in there, unless they have cash and they're buying with cash.
Exactly.
You need any financing at all, you need a financing condition.
Exactly.
So when you're pre-qualified, as you call it, that will qualify the buyer for creditworthiness.
So there's two different parts of a mortgage application. So there's you coming through as the applicant to be qualified financially, and then there's the home. Right. So the home has to come through too, for the value that you're paying for it, and just to make sure it's insurable. Because a mortgaged home has to have home insurance.
Right. So is that where we get an appraisal would come into play? So Joe Buyer comes in, gets pre-qualified. I can buy a house for up to $300,000.
Usually give a range. Yeah.
And then they, Kathy takes them out. They have a wonderful time, have this trust relationship with Kathy, and then they find a house they want. Kathy writes an offer with a condition on financing. So then after that happens, then they come back to you with the specifics of the house. Yeah.
So generally, if somebody's coming in to see if they just want to be pre-qualified, I'll do all the legwork then. So get a good idea of what the member's looking for. We get a really good range where they're at. I don't normally pull a credit bureau at that stage, so I kind of like them to have a good idea of what's outstanding, so we can, based on the information they're giving to us, we can give them a price range.
So the credit bureau, that's like their credit score.
Absolutely, yes.
So how does that factor in? If somebody had, past due payments or, had crippling debt 5 years ago, how much does the credit history or the credit score play into their ability to get financing?
Oh, it plays in a lot. Like if you've never borrowed before and you have no credit score, it's not just as bad, but it can be detrimental if you've borrowed and you've missed some payments and you've been late a few times. But we see that all the time. A lot of times, maybe a member's bureau isn't as bad as they think it is. And in which case, if you're worried, if you come to see me for pre-qualification and you're worried about your credit, I would get them to sign, and let's pull a credit bureau right now and let's see what the issues are, if any.
So and then we can see a record of that debt, whether it's just a credit card, their record of paying the debt, exactly. or if it's a car loan or whichever you want to see. So how are they making those payments?
A good credit score is achieved not by the number of things you have on the credit, your credit bureau. It's not getting store cards all over the place. It's absolutely just having, say, a credit card and, say, a loan over 2-3 years that have repaid well. That's all you need. That's all you need.
So for somebody just starting out, getting a credit card or getting a small loan and making those payments would be advisable to just get their credit worthiness ball rolling.
Yeah.
Good. So now it's one thing to make your monthly payments on your mortgage once you get it and everything, but there's this big thing called the down payment. Now, what's the deal with that? How much do you need? How's someone supposed to save up for this huge amount of money?
That's a very valid question, because I mean, quite often if somebody's in their, mid to late 20s or early 30s, they're paying rent also. So it is tricky to get that down payment set aside. So sometimes when we look at meeting with somebody to do a pre-qualification, it actually turns into a plan. Okay, it might not be doable today, but let's focus on getting this, and this paid down over the next. Let's come up with a 2-year plan or a 1-year plan to get your everything under control, so you're ready. You're in a strong position to buy a home.
And so how you're going to save for that down payment and keep buying your lottery tickets.
Yeah, yeah. Fingers crossed.
What if mom and dad have some money saved for you or something like that? Like we've seen that a lot lately. How because it's so hard when you're paying rent. What if mom and dad want to contribute, or you get an inheritance or something like that? That you can use that for down payment?
Absolutely. And the minimum is 5%. So to get yourself into a home, you only have to have 5%. Plus, we like to see that you've got a little extra for the closing costs.
Right.
Currently, the lawyer is, the government is picking up the land transfer tax for first-time home buyers.
Right.
That usually is quite a big lump sum.
Yeah.
It can be depending on the value of the home.
Yeah, the land transfer tax is, for those that don't know, it's a tiered amount of money that you have to pay when you purchase a house when it's not your first purchase. It's like 1.5% on the first $300,000, but that's not the right numbers. That was just something picked off.
I think it's pretty close.
It's based on the purchase price.
Yeah, and then as the price escalates. Fortunately, we're in an area of the province where there's not a municipal land transfer tax. For those that may be listening in Toronto, they get doubled up. The province takes a land transfer tax, and the municipality of Toronto takes a land transfer tax, and they're paying a huge amount of money for those houses. So that turns into quite a substantial amount at closing.
It does. So then we got that's what we like to do when we pre-qualify. So we're letting the member know that you have your 5% down. You need at least, say, $1,500 to $2,000 for lawyer's fees. There's also, if we're going with Genworth or CMHC, so if you don't have the 20% down, so anything below that, so with this example of 5%, on that Genworth premium, there is going to be an 8% PST that has the premium gets added back into the mortgage, but there's a PST of 8% on the premium.
So that's in your mortgage payment, or you have to have that up front.
No, the premium itself is added to the mortgage payment, but there's an PST of 8% on the premium that has to come. We have to have that on closing.
So this is a great example of how in depth this mortgage process can be, and why you have to get a professional. So when somebody has applied for their mortgage, you're going to tell them what the mortgage rate is, like the interest rate. You're going to tell them what the term of the mortgage is and the amortization. What are those things, and what do those things mean? So what's the term of a mortgage?
Yeah, so the term is so when we quote an interest rate, so currently the 5-year interest rate is 2.99. So if we're looking at that rate is good for 5 years. So that's the term.
Okay.
The amortization, of course, we can't pay $200,000 off over 5 years.
That would be a big payment.
Would be a very big payment. We'd never have anybody buying any homes. So the amortization is 25 years.
So they take the $200,000, spread it over 25 years, but the actual term that your interest rate is, and when it comes up for renewal, is that 5 years.
That's right.
Okay.
That's right. And there is also the qualifying payment. Now, people might have heard bantered around like the stress test, the qualifying payment, and it scared some people off, I believe. But like I haven't, to be honest, as a lender, had too much trouble getting things approved, taking that into account.
With the stress test, you have to, as a buyer, qualify for a higher interest rate, don't you? Is that correct?
Correct, and that's one that the government mandates that. So currently,
just to keep things safe.
Well, so the idea behind that, and I do agree with the stress test. So its current rate is 5.19. So although you're paying a mortgage payment based on 2.99, I've got to qualify you as if you could afford 5.19. And the reason they came up with that is because interest rates are so low right now and have been for quite some time. The government wants to make sure that in 5 years' time, when your mortgage becomes due, what if it's now 4.99 or 5.99? Can you still afford your home?
That house.
Right.
So it's protecting from foreclosure and from a potential.
It's just making sure you're making the right decision.
Yeah.
Mm-hmm.
Because nobody wants to be mortgage poor.
Yeah,
right.
For sure. And that we talked about this in our last podcast too. You figure out where you want your payment to be, what kind of house you want, and that you're going to be able to have the lifestyle that you're used to, and you're not, house poor and just eating Kraft dinner out of a cat.
No, exactly. And if you've managed to save, say you've been at home, you're still at home and you're in your late 20s, which happens a lot because it's affordable, and you've managed to save a lot, then maybe the conversation needs to be, okay, what kind of improvements do you need to do on this new home?
Yeah.
Should we be holding back some of your savings? Should we be, so it's a whole conversation about what the member in front of you really needs.
So
what do they want?
On that note, let's say somebody buys a house that does need some work. I've heard of purchase plus improvements. So this, I believe, is you get your mortgage amount, but then you get a little bit extra that you could use for projects in the house, or? Yeah,
so basically it's the certain percentages that CMHC and Genworth will allow without too much trouble. The problem, not problem per se, it is a little trickier because now I'm going to base you still have to have 5% of what you want for your home improvements. So say that's 40,000.
Right.
Your mortgage is 200. You want to add 40 for improvements. Now it's 240,000. You have to have 5% of the 240.
Right.
And it's all advanced at once. And there's a holdback of the 40,000 for your home improvements.
So you guys keep the 40,000?
It's just literally undispersed from the mortgage. So it's sitting there ready to be dispersed, but you are paying interest on it from that first day.
Yeah. Now, so then I go and I replace my siding and windows, and then
the bill comes.
Then the bill comes and it gets
so
paid with that money.
The whole purpose behind that is that we need estimates, we need quotes.
Yeah.
So say it's the windows and the kitchen and the bathrooms, and we get those quotes in. And then we have to send out, so say you get your kitchen done, but you haven't got the bathrooms or the windows done yet. That's okay. You bring in your invoice for the kitchen. You have 30 days generally to pay your invoice. We release the funds. We have to have an inspection done.
Right.
So we'd send an appraiser out just to have an inspection to make sure it's done in good workmanlike quality. And once he says that, yes, the kitchen's been done, we can release how much the quote said was needed for the kitchen.
So this is a way for people to front load their mortgage with those renovation costs that might come up over time.
Yeah, so that fixer-upper that you might, you might be really interested in this home, but you don't have the money to do the kitchen that really needs to be done.
And then they're borrowing that money at a mortgage rate as opposed to if they were borrowing that money at not a mortgage rate.
Exactly, because the only time that you can go over 80% loan to value, which means, 80% of the value of your home, is when you purchase. You can go up to 95%, and you can even add on for improvements.
Right.
But that's the only time.
Okay.
Once you've purchased it, you can't come back and say, I want to do those renovations now. Can I add it into my mortgage? Because now I'm tied to, it depends on what the property value is today.
Right. Okay, well that clears things up on that note. I do have one general question because everybody has the bank that they'll typically work with, or they have people ask us about mortgage brokers, like you're at Mainstreet Credit Union. There's all sorts of financial institutions. So what is the difference between a traditional bank, a credit union, using a mortgage broker? How can people kind of look at those as different options? Because just like realtors, everybody has their different taste in how they're going to do things.
Absolutely. So. The biggest difference between the credit unions and the banks is that the banks are owned by shareholders, like they're publicly traded, but the credit union is owned by the members. So when you become a member of the credit union, you pay the $50 membership, and that you become a member, you have, you can go on the board if you decide, you have an option, you have a say.
So it's a bit more like a cooperative, is that?
Yeah, it is. It's a cooperative movement.
Right,
and basically, I feel I have worked in another financial institution before, in a bank, and the credit union is different on some levels because we have more say and we tend to look more at the bigger picture. We have a little, we are governed.
A little more community. You guys in Libro are a little more, well, I guess all the banks are kind of community minded, but they just feel a lot bigger, the larger institutions.
I think there's a few more restrictions quite possibly, but I mean, that being said, it's like, the thing is, we are all governed by the same rules from the government. We can only do 80%. We have to, in a conventional mortgage, in a refinance, we are all governed by the stress test. Like our governance is all the same.
A mortgage broker too.
Well, a mortgage broker is different again, because you go to see a mortgage broker and he's going to get you into the best rate possible. That's what he's looking for.
Okay.
He's getting somebody who will accept your application and give you a good rate.
Would it be a bank then?
Well, he will go off and get you that rate from all different banks. However, that being said, that mortgage broker might be a friend of yours and you go through the mortgage broker, but once he's got your mortgage in place, you don't go to him if you have any issues. It's the bank that now holds the mortgage. Okay. He doesn't do the financing. He finds you somebody who will finance your mortgage.
Okay.
So, and that mortgage broker might find you the cheapest rate, but you also want to look at your discharge penalty. I always tell people that in case you sign on for that 5-year term and maybe your circumstances change in 2 years and you come to us and say, Jeff, I need to sell the house. I've got 3 years left of my term on my mortgage. And we're going to say, go to your bank and find out what your discharge penalty is. And that's important to know up front because they can be quite pricey. Is that right?
Well,
Sandra?
they're a 90-day interest rate penalty or an interest rate differential. So say, for instance, your mortgage was in at 6%. And then in 3 years' time, mortgage rates are now 4%, just for ease of reference. Right. And as an institution, anyone, bank, credit union, that we're all the same on that note, we're looking at, okay, now we've got to pay that mortgage out. We've got to discharge that, but we can't get that money out again at 6%. We can only get it out at 4%. So you pay the extra 2% to the end of your term.
Right.
Okay. Or a 90-day interest, whichever's the highest, basically. But is
every mortgage the same, or does it depend, like each mortgage might have a different policy for the discharge penalty?
No.
They're all the same?
All the same.
Okay.
Yeah. But we try to, if that same member comes and needs to sell or wants to upgrade, had, extra children that they weren't expecting or whatever, and need to upgrade, then we tend to try and, we've got a number of things that we can do if the mortgage is staying with us to try and avoid that penalty. Yeah. Like there's like an interest rate blending and port it over. Yeah. So there are lots of options to try and avoid that. Now, obviously, if the home's getting sold or going to another financial institute and we're not able to get those funds back, then the penalty has to be charged.
Yeah. So obviously, lots of information. It's very clear why you need a professional working for you. There's so many details. Thank you, Sandra. Whether the professional you choose is Sandra Coombs at Mainstreet Credit Union or the professional that you currently work with at your bank, you'll be in good hands, and they obviously know what they're talking about. This is really important quality information. Thank you so much for being with us, Sandra.
You're welcome. Thanks for inviting me.
We're HomeField Group, and this has been another episode of Real Talk.